Philip, we'll get into bonds shortly, but it's not every day I sit across the table from the Australian captain of an elite sporting team. Can you tell me what is GATEBALL and how did you get into it? And how does a bond researcher end up being the Australian captain?
GATEBALL is an unusual sport. It's a form of croquet. So it's what people think of as croquet is about the right idea. You put the ball down on the grass, you hit the ball through in croquet it's called a hoop, in GATEBALL it's called a gate. I got into it about 10, 15 years ago when I was living in Canberra. Unfortunately, I hurt my back quite badly when I was younger, so I couldn't play sort of full-on contact sports. And I've got a bit of a mathematical brain, and a mate of mine said, I play this game called GATEBALL. You should come down and you should give it a go because I think it's your sport. And he was right. It's a combination of, there is skill and finesse and strategy, but there's not a great deal of power. It doesn't matter how hard you hit the ball. It matters just getting the right amount of touch on the ball. So in that way, it's a bit like sort of billiards or snooker and things like that. And I got into it, and it's quite a complicated strategic game. So yeah, a lot of the best players are actually pretty intelligent men and women. That's worth pointing out because it doesn't have a lot of power in the game. It's a co-ed game. Men and women play in the same teams in the same competition because it's not about power. It's about brain power and about touch and finesse.
How did you rise to the Australian captain position?
A lot of practice and the strategies. There are a lot of players who are really good at hitting the ball. They hit the ball better than I do. But if you're trying to hit it to the wrong place, you're better off hitting it to just the right place and having just the right strategy. And that's how I kind of took my team to successive national championship wins as that captain. And once you win the national championship twice in a row, the Australian team sort of says, hey, yeah, maybe we should be using your strategies. They seem to be better than other teams' strategies. And that's how I got named as Australian captain.
Okay, we're going to come back to these strategies because I think it's really interesting. But I want to get into the world of bonds. I've been someone who historically has thought of bonds as boring, but I've had some exposure in the last few weeks, and I'm starting to see how they actually are quite interesting. The history is quite interesting, and I'm seeing the value that they can provide to someone who invests in equities as well. So what can you tell about the world and society through the lens of a bond?
What you can tell about the world and society by looking at the bond market is very much how scared they are, how confident they are. Those two things show up in bond markets, generally speaking, before they show up in equity markets. The reason for that is that, as you say, a lot of smaller investors view equities as where it's at, and bonds are this boring afterthought, or they're not even thought of at all. But the wholesale international bond markets are larger than the equity markets. They tend to have more sophisticated investors and definitely a greater proportion of sophisticated investors. So they move first. I have vivid memories of talking to I used to sit next to the equity team at work, and I came in one morning, I said to the equity traders, like, you and I, we need to talk about the Bank of Japan's US dollar swap line, because he'd never heard of it. And I, 3 or 4 times across the course of the day, I tried to get him to talk about this US dollar swap line, and he never did. And then that night, in reaction to that news, the equity market fell about 8%. That tends to happen in bond markets. So if you're trying to look at the world through the lens of bond markets, you get the instantaneous, quickest reaction from some of the smartest investors on the planet is how it shows up in bond markets. And that's where it shows up. And that's where it shows up first. You can see what people think about something like what is the central bank going to do in the next 6 months or so? But also you can see, is this government stable for the next 10 or 20 years? Different parts of the bond market can explain those things to you.
Let's talk about FIIG as a business. FIIG's been around for 25 years. It's something that has been, I've always known about FIIG. It's kind of been one of the central bond players in the Australian market. Can you tell me about, if I was to approach FIIG and open up an account, what am I doing? What am I seeing?
The bonds are an excellent investment for anybody who is seeking sort of diversification and capital protection. The problem with bonds in the Australian market is that you can only buy them in lots of $500,000 if you're wholesale. Now, what FIIG provides is a way to buy those bonds at much smaller volumes. So if you have $500,000, even $50,000, $1 million, $2 million to invest, those sort of numbers, you could really benefit from having bonds in your portfolio, but you can't access the wholesale market. So if you join FIIG, get an account at FIIG, what you'll be offered is an interview with a relationship manager who will discuss with you what sort of bonds meet your personal investment preferences, and then you'll be shown how to invest in those bonds. And because FIIG is buying them wholesale and then offering them to you in smaller parcel sizes, you can then buy enough bonds to be diversified and actually achieve a proper bond portfolio with numbers which are much less than you would need if you were doing it wholesale on your own behalf.
And so it's not just a marketplace where, you guys have a whole huge plethora, like hundreds and hundreds and hundreds of bonds from all across the world for people just to put into a filter and select whatever they want. You are vetting these and you've got to ensure that they are of, say, investment grade before putting them onto the platform, correct?
Correct. Yes, but you got to be careful. Investment grade has like capital I, capital G.
I've just gone into I didn't mean to put it into bond jargon.
Yeah. So actually, that is my job at FIIG. I'm the head of research, so it's my job to look through the market and see which bonds that are available would be appropriate for our clients. Now, many of those, even most of those, are investment grade, which for those who know is S&P rating of BBB or higher. We do also have carry bonds, which are lower rated than that, which are slightly more high risk, high return. So they're not officially investment grade, but they're the ones we judge as still being worthy of investment if you're prepared to take that slightly extra risk. That's what the research role at FIIG is. And yes, there are tens of thousands, hundreds of thousands of bonds available globally. Our menu is not that large. We could choose any of those. We tend to have a much smaller menu that actually helps clients achieve what they're trying to get without just having a blizzard of possibilities. Yeah.
That's a good description. Can we go into? Do you mind actually stepping back and talking about those ratings? Because people have probably always heard BBB, triple A rating, double B, whatever it is. Can you break those down and tell us what they actually mean?
Yeah, they're an assessment from a rating agency about the likelihood you will receive your money back on time and in full. So AAA is the rating agency saying that this is guaranteed asterisk, there is a very, very tiny risk. So very large, very strong organizations are AAA, like the federal government is AAA.
Are any corporates AAA?
I don't believe so anymore. They did used to be a few, and then the financial crisis happened in 2007, and the rating agency realized that actually that wasn't a great plan. So you can get some very strong corporates and smaller governments. So things like the big four banks, Government of Victoria tend to be AA. Single A is a largish, very strong company. Triple B is sort of like a medium-sized company getting slightly more risky.
What would be triple B?
A lot of companies that you sort of are aware of and know can be triple B. I was looking today, Woolworths is triple B, Origin Energy is triple B. They're ones I was actually just happened to be looking at this morning, so they're right at the top of my brain. As you get below triple B, you're starting to get to be a bit more speculative. Now, triple B is what the rating agencies define as investment grade. So things below triple B are non-investment grade. So double B is where things are starting to be a bit more high risk. So you will find that some of the subordinated bonds from banks can be double B.
What does subordinated mean? Just for people who are unaware. Sorry.
If a company goes bankrupt, they pay out their money in order. If you're subordinated, you're volunteering to be at the back of the queue, so you'll get your money last, which means if the company goes bankrupt, you've got a much greater chance of losing money. But the payoff for that is you get higher interest each year. If you're volunteering to be at the back of the queue for a strong company, well, maybe the back of the queue is not a great place to be. There aren't many double B companies in Australia because if you're close enough to being investment grade, there's a lot of benefit to being investment grade. So anyone who is at double B tries to become triple B. Then single B, you get some of the more risky companies, smaller mining companies, those sort of things. They are really quite sort of high risk, high return. And as you get below single B, you get down into the Cs. That's when things are really questionable, and D is default.
Right. And where would, so if someone maybe is familiar with the term junk bonds, where do they come in that scale?
Junk bonds are normally bonds in the Cs.
In the Cs.
So a junk bond is a bond where there is a real chance of losing your money. Maybe we should take a step back. The whole point of a bond is that you're not risking your capital. You're getting interest and you'll get your capital back at the end. Now, that does mean that, if the company you've lent money to goes wonderfully well, you'll still only get your original capital back. So you don't have that big upside. And the payoff for that is that you're not supposed to have much downside either. That unless the company goes absolutely into default, you get your money back. So if you lend money to a company and the company's sales fall and its share price halves, you still get back the exact same money you lent it. And it's only if the company is actually in default, in administration, gone bankrupt, that you might not get your money back. And to be honest, even then, depending on what sort of bond you've got, you can still get your money back. So it's junk bonds are bonds where that whole administration default scenario is live. Instead of it's always technically possible, but junk bonds are bonds where that's not just possible. That's a real live probability.
Right. So let's then jump back into your day-to-day job. Mm-hmm. So you've got a world of tens of thousands of bonds out there around the globe.
Yes.
Here, local market, in private and public companies, in state governments, the federal government, etc. Can you tell me how you actually research a bond, and is there differences? What are you looking for in government bonds compared to corporates, etc.? So how does that process unfold for you then to give it the tick to put it on a platform?
Right. What we're looking at is appropriate return for the amount of risk you're taking. That's the overriding question.
So it's not looking to minimize risk. It's just making sure that relationship
getting adequately compensated for the risk you're taking. So the fact that a company is risky or may not work out is not a reason not to invest. Startup equity markets can have, high risk, high return options in them, and bonds do also. High risk, high return for a bond is still lower risk than a high risk, high return equity, but they do still exist. When I'm looking at a bond, what I want to see is often it's to make sure that when you get down into the entrails of the annual reports, that the company does what it says it does, and then when you look on the tin, what the management says what they're doing is what their accounts say they're doing, and that's a sign that the company is being run properly, and that you have the right sort of return characteristics. What I don't like to see is a company that say they're doing one thing and then you look at their accounts and actually, well, no, that's not happening. They're talking about all this growth they're seeing in North America, and then you're looking at their accounts. Well, actually, your sales are falling year on year. That's not what I want to see. So,
what are some red flags to you there? What other red flags are there when you're looking at that management, comparing what management is saying to what you're seeing come through in the numbers? What's the more common stuff that you see that you know?
Particularly at present, what a red flag is, you don't want to see anything where there's no give. The last few years in the economy have been, this is actually my background as a macroeconomist, the last 2 or 3 years in Australia have been great. We've had strong growth, very low unemployment. Yes, inflation's been a problem, but that's not really a problem for companies. That's more a problem for individuals on cost of living. So if you're running a company, it should be building up margins now. Make hay while the sun shines. The sun's been shining. Fix the roof on a sunny day. That's what the company should be doing. So if you're looking at a company where, they're only just making it through, or even though that margin's not improving at all, that's okay. No, it actually should be improving at the moment. And so you're looking at the risk inherent in a company from are they being able to sort of build resilience over this period so that if something goes wrong in the next 2 or 3 years, they've got a fallback position.
So they've got a strong balance sheet.
Yeah, a strong balance sheet. They've got healthy profit margins, if possible, growing profit margins. Those sort of things are what we're looking for. What we don't want to see, and particularly in Australia, because a lot of banks and sort of finance companies, you don't want to see a company which has, very tight margins and incredibly low losses right at the moment, because. And I won't say which company, because we did turn down a deal recently because you are running just profitably. You have the same average profitability as you've had for the last 10 years, and your current losses are at 10-year lows. Well, hang on a minute. What happens if there's a bit of a slowdown, even a recession, and your losses rise back up to average levels? Well, actually, if you move your losses back up to average levels, suddenly your current profit margin, which is average, drops dramatically. And it's like, so that was why we turned down that company. That's the sort of thing we're looking at. It's not just about what's in the accounts now. It's how what's in the accounts now matches up with the overall economic profile of Australia at the moment, or the US, or the UK, or whichever currency we're in.
So taking a step back from a company specific one, let's talk about perhaps a government style. What are you looking for there?
Okay, government bonds are incredibly unlikely to default, so we're not really assessing default risk. What you're actually assessing is something called interest rate risk or duration risk. People listening to this will probably be aware of how a mortgage works, and they have the option of fixing their mortgage. That's essentially taking a gamble on, well, I can fix the mortgage rate today, and it might go up and it might go down, but I know exactly what I'm going to get. So if you're going to do this properly, what you're trying to do is fix it while it's really low, and then it rises and you don't have to pay. Now, that's if you're the one paying the interest. If you're investing, you're the one receiving the interest. So what you actually want to do is time it so that, I can buy my fixed rate investment now while the interest rate is high, and if the interest rate falls in coming months, I'm already locked in. I get the higher interest rate. That's a different sort of assessment. You're not trying to assess the government itself, because the odds of the Australian government going bankrupt the next 5 years are incredibly low. Now, what's the odds of the RBA lowering the cash rate 100 points over the next 5 years? Well, that's quite plausible. What's the odds of the RBA raising the cash rate over the next few years? Lowish, but not impossible. And it's about judging those probabilities against the probabilities implicit in the market from the interest rate you're being offered. So if you're being offered, 4.5% fixed, 5% fixed for 5 or 10 years, actually that looks pretty good, because at the moment I can get 4.5 or so and about 4 in a term deposit. But if I could lock that in for the next 5 years and the RBA starts cutting rates, all of a sudden when everyone else is still trying to find a term deposit and term deposit's going 4, 3.5, 3, I'm sitting there with my fixed 4.5% and I'm sitting pretty. That's what we're trying to judge when you're judging government bonds. It's about timing that duration perspective. When do I want to fix the interest rate rather than sit in a floating rate?
Are there any signals or things like that you're looking for there?
It's about trying to judge the economy. And it's about, if you look at the short bonds in a market, you can tell what the market is expecting the RBA to do, and then trying to judge, is that what I actually think the RBA is going to do? So at the moment, it's kind of curious. The market is expecting the RBA to cut rates for the next year or 18 months and then start raising them again, which is actually odd. That's not something...
Yeah, you'd think maybe set a neutral rate.
Yeah.
And rather than have this kind of seesaw effect.
Yeah, it's funny. The markets refer to it as a Nike curve, because it looks just like the Nike swoosh shape on the... Right.
So that's symbol. Why I'm not in the bond game. I don't know. I've never heard the Nike curve.
Well, it's when the interest rate is expected to drop for a little bit and then come up. So it has a tick shape. It looks just like the Nike symbol. And so that's what we've been highlighting to our clients, is that the RBA is likely to cut rates. Everyone kind of knows that. If you buy a 2-year bond, it's already there. It's already priced. The market's onto that. But the market is then suggesting the RBA would then raise rates across 26, 27, 28. And that looks a bit odd to us. So that actually, if you were to buy a bond that matures in 2026, 27, 28, 27, 28, 29, you get a bond which is locking in a much higher yield than I think is likely. And if you do that repeatedly, that's when you start to actually get quite impressive returns from a bond portfolio.
I'm sitting here thinking as a homeowner now, thinking about this tick, thinking, do I look to lock in a lower rate towards the end of the year or to early 2026? Is that what the bond? I don't want to say. Is that what the bond tea leaves are telling you?
If the market didn't change for the next year, then yes. But I must warn you that there is a pretty good chance that what the market has in a year's time doesn't look the same as now.
Okay, before I go and speak to my mortgage broker, I'm giving you a call, Phil. Let's now let's take a step back. You've researched these bonds.
Yes.
You and your team have given them the Hart Foundation tick of approval. They've come onto the FIIG platform, and now I'm there. I've got my $100,000, $200,000 from my SMSF that I've allocated to fixed interest. What's the worst thing I can do, and what do you want to see me actually do? What does an ideal client, what does the worst client do, and what does an ideal client do when it comes to actually building that component of their portfolio?
The clients that make me nervous are the clients who get very excitable about the last 10 or 15 basis points. The purpose of bonds in a portfolio is that in the long run, like a well-managed bond portfolio will produce slightly less than the equity market. You will get a slightly lower return. So why would you ever do that? Well, the answer is that every so often the equity market loses 20, 30, 40%. And on the day that an equity market loses 30 or 40%, the bond market probably gains 15 or 20%. And that diversification, because if you run into a massive recession, what happens to interest rates? They collapse. So if interest rates are falling and you've locked in a 5% interest rate, all of a sudden that's incredibly valuable. So if you want bonds in your portfolio to provide you that diversification risk to protect you against the days there are large falls in the equity market. And that is completely true. That's 100% bond theory. You'll find that in any textbook anywhere. But that's assuming that the bond you've bought is a nice, strong, stable bond. If you're chasing the very highest return, you end up in the riskiest companies. And then actually when you hit a recession, those risky companies actually struggle. And so your bond struggles those days as well. And you've then undone the benefit. So the best clients in bonds and the ones who get the most out of bonds are the ones who don't chase the very single highest return and instead look for the highest return available at a given level of risk. So that's what people can do wrong. If they just say, I don't care what sort of bond it is, just get me the highest bond. I demand 6% yield. Like, to be honest, we've had it. This came up recently. There were two bonds that came into the market at fairly similar times. One was from Pacific National, subordinated bond from Pacific National, and one was from the New South Wales government. And the difference in yield was only sort of 50, 75 basis points. And you look at the underlying risk, subordinated debt, so to be at the back of the queue from a company that's relatively highly leveraged that runs trains that move coal around and wheat, or the New South Wales government. And some people said, no, I just want the highest yield, so they bought. And then Pacific National was unfortunately caught up in the Whyalla stuff and had some other issues. And so they've had a difficult time, whereas the New South Wales government is just chugging along. And that short-term focus on choosing the single highest yield today caused clients to miss that actually you were better off accepting a slightly lower yield from a much safer entity.
So it's about a risk-adjusted return.
Yeah, bonds are about risk-adjusted return. They get you protection from days when the equity market has terrible collapses, and they get you predictable income. And the cost for that is just sometimes you get a very slightly lower yield, but you end up with a much safer position overall. And it's clients who lose sight of that during the good times are the ones that have trouble during the bad times.
And is it about building out a portfolio that moves up and down that scale? So you have, you get an average, you're looking to get an average return from your portfolio in that kind of, in the sweet spot in the middle, and with a combination of more of those robust, stable, say government style bonds, and with a smaller amount of those. Is that a way of thinking about it that you educate the investors with, or is
it's about the relative return, like for various reasons to do with the way governments are borrowing a lot of money. The actual difference in return at the moment between relatively risky corporate bonds and relatively safe government bonds is really very low. Like historically, it's been, that spread could have been 2%. And it was down at sort of 50, 75 basis points. So like if you normally get paid an extra 2% for taking that risk, and right at the moment you're only getting paid 75 basis points,
it's not worth it.
Not worth it right at the moment. And well, actually that was a month or so ago. Funnily enough, the company I'm talking about, Pacific National, still has some difficulty, but you're actually now getting a much better return for it. So it's about trying to balance and making sure you don't just chase that single highest yield all the time. You want a good mix of things, and when you take that risk, you take it with your eyes open and get adequately recompensed for it. So an interesting category is actually something called RMBS, residential mortgage-backed securities, which have very different. The They can sometimes have a slightly bad name because they were part of the problem in the GFC, but they were the American-style ones. The Australian ones are designed differently. But because of that history, when things start to look a little bit scary, the prices can move dramatically. So sometimes you can get 400, 500, 600 basis points extra from having those risky bonds. And sometimes you only get 200 extra. Well, actually, it's worth buying at 600. It's not worth buying at 200. So it's not about a category. I don't think there is any category that it's never appropriate to buy. It's about what is the risk reward I'm being offered for that category at the moment. And that's making sure you choose that correctly is the right way.
Okay. So I've got some questions here. And I wanted to know, I had a fellow from PIMCO in your seat, and he was shorting some bonds as well at the moment. So I wanted to understand how you express a view in the form of investing through a bond.
Shorting a bond is an unusual one. That's selling a bond you don't own. That's not a service FIIG provides. That's a wholesale only thing. That's only for the very biggest of the big boys, of which PIMCO is about the biggest there is. What you can express in the same way that, talking about mortgages before, that if you think the interest rate is going to rise, you have a fixed rate loan. If you think it's going to fall, you have a floating rate loan. You have that option. So if you are going to invest money and you think interest rates are going to fall, you buy a fixed rate bond. The interest rate is going to be lower tomorrow. I'll take today's one. If you think the interest rate is going to rise, you buy a floating rate bond. And that will help express the view. The other thing you can do is if you think that the company being offered, that's an interest rate view. A credit risk view would be expressed by saying, well, actually, I think that this bank bond I'm being offered is very good recompense at the moment. If I buy this bond now, in 6 months, a year, 18 months, the recompense people are being offered will be lower, which means that my bond will have risen in price. Because of the way that interest rate works, there's a strange relationship in bond markets. So when interest rates start falling, bond prices rise. It's the same. We've been sort of hinting at it, the mechanism.
Because people are happy to pay up for that higher yield.
Yeah. If I'm going to give you a bond which gives you a coupon, say, of $5 at the end of the year and your $100 back, and I buy that at a 5% interest rate, that's $100 now, $105 in a year's time. If the interest rate drops to 3%, well, suddenly my bond's worth 102. So as interest rates fall, bond prices rise. And the longer you have a fixed rate bond, the greater the impact on the price from that change in interest rate is. But that applies to credit spreads also. So if you think that at the moment I'm being paid an extra 1% a year or 2% a year for this company, but actually this company is really quite stable. I think the fair number is like 1.5% a year extra. So I'll buy it now, and then in a few months' time, it has fallen down to 1.5%. All of a sudden, I've got that extra 50 basis points a year for the whole fixed term of the bond that now belongs to me. So that's how you can express views in bonds. That is something that is harder to do for our sort of FIIG investors, because they PIMCO, if you're buying and trading bonds with PIMCO, they have more resources to put towards the problem than you do. What you want to do is to make sure that your bond portfolio is well positioned in a medium-term sense for the risks you see across the medium term. So right at the moment, the risks we see in the medium term are that the RBA would cut rates, but would actually keep cutting them. As I said, the market is pricing some rate cuts, then some rate rises, and that strikes me as odd. I think it's probably far more likely that you get rate cuts, then a pause, then some more rate cuts, actually. The current situation reminds me a lot of 2011, 2012, where you had the financial crisis. They had the boom following the financial crisis because everyone cut rates.
And then we had to see the brakes get applied a little bit.
Yeah. So across 2009, 2010, interest rates rose dramatically, and we had a relatively soft landing in 2011 and 12. And so the RBA cut rates a little bit, and then inflation didn't wake up. And so they cut rates some more, then they waited a bit. Then inflation was low and wage growth was low, so they cut rates again, and they waited a bit more. And across sort of 10 years, you had this really long, slow rate cut cycle. I think that's what we're setting up for now. That actually the Reserve Bank is sort of talking about we're worried about a wage price breakout. I this podcast isn't quite the right way to do it, but I'm talking to, particularly when I was working for the bank, talking to a group of bank employees, say, right, I haven't had particularly good negotiations with my manager about my wage recently. Wages are growing, but they're growing only just more than inflation after having been well lower than inflation for the last 3 or 4 years, which was supposed to be a really strong period. If you couldn't argue for a wage rise over the last year or two when the unemployment rate was lower than 4% and there was a desperate shortage of employees, what makes you think employees are going to be able to negotiate massive wage rises over the next 6 or 12 months when actually the economy is a bit weaker? And so if those wage rises don't come through and the inflation rate stays here, then the RBA will just keep slowly cutting rates for an extended period. And that's when, if you'd bought a 5 or a 7-year bond now, and across that, which was implying that the interest rate was going to rise in year 3, 4, 5, 6, and actually what happens is that interest rates fall in year 3, 4, 5, 6, you'll be really pleased that you locked in that higher interest rate.
Let's give the equity investors something to take away here. How can equity investors look at the bond market, look at something like what you're doing, what's maybe getting the tick of approval from your team or not as well? What could they take away? What actual insights can they take away from, say, an active bond manager?
An active bond manager will be far more cognizant of risks. It's a bit of a stereotype, but it is broadly true that because equity markets, you own the upside. If the company does really well, you own that. So equity market analysts are looking for the best opportunities.
They focus very much on that growth, the total addressable market, all that kind of stuff.
Yeah. Bond market analysts, because they don't own that upside, but if the company goes bankrupt, we get into a problem.
You're on a hiding to nothing.
You're not hiding to nothing.
Quite.
You're getting your good, solid return every year.
Yeah.
But you're much more attuned to risks. So at a period like this, when equity markets are, well, I'm not an equity market analyst, so to my semi-skilled analysis of equity markets, look to be, like, even after the big fall in the last sort of few weeks, still look to be pretty high generally. There's got to be a lot of risks there. And I don't see equity markets people ever talk about what's the risk that actually the equity market corrects down another 15, 20 or 30%. Because the run-up over the last few years has been astonishingly high. But they never talk about that risk. And that's what a bond market analyst will talk to you about, and they actually also explain to you that if there is a large correction in the equity market, that's when bonds do their best work. So that's what an equity market investor should be listening to a bond market investor about. Where are the risks? Where are the risks in the system? It's funny. I used to work at Citigroup. People often ask me, like, when did the 2008 financial crisis start? The answer is July 23rd, 2007. Because that was the first day the bond market saw an issue. You can go back and you can look at it. Something we were talking about earlier before we started.
What did that look like? What did it look like when the bond markets saw an issue on that particular day?
That was when the cost of lending money to a bank, which had been sitting at about 15 to 20 basis points for years, jumped to 35 in a day. And that was bond markets saying there's not enough cash in the system. There's something wrong. There's not enough cash. And for a further 9 months, equity markets kept rising and bond markets kept saying, this is broken, this is wrong, this is wrong. And then we know how 2008 played out. And that's a extreme and self-serving example, I acknowledge, but that is what bond markets do. So if bond markets start flashing red and sort of saying, look, there's an issue here, there's an underlying structural issue, bond markets will identify that for you well before the equity markets do. And just quietly, at the moment, the one that's flashing red is US government debt.
All right. What should people keep an eye out for there to see that flashing red increases or goes even more alarming?
What's been happening in the United States is, and funnily enough, as damaging as it is in the short term, the massive cuts that are coming through in the US at the moment are possibly one approach to solving the problem. Is that anyone who's been to one of my presentations before, I have call it my favorite chart. It's one that keeps me up at night. It's a chart of the US government deficit against the US unemployment rate. And for 70 years, it goes back to 1960. And what it shows is that, as you would expect, when the economy is really strong, the unemployment rate is really low and the government deficit is really low. When the economy is really weak, the unemployment rate is really high and the government deficit is really high. And that relationship holds for 70 years. It broke in 2016. And what's happening now is that the US government is running a deficit of around 7%. That is just under the 8 and 9% deficits that they were running in 2008, 2009 at the height of the financial crisis, when the unemployment rate was 8, 9, 10%. At the moment, the US unemployment rate is in the 4s. So you have an unemployment rate which looks not quite, but damn near as strong as it's been in the last 70 years. The absolute low is slightly lower than this, but you're just a little bit above that. So you have the strongest economy you've had in decades, and with the exception of the GFC and the pandemic, the largest deficit you've had ever. Those two things don't coexist. And so when I say that's flashing red, that's one of the reasons that there is a political movement to bring the US deficit under control. Now, you can argue about how and why that should happen and how and when it should happen, what mechanisms. But the concept that the US government can't keep running a 7% deficit during one of the strongest economies they've ever had, that's pretty clear. Remember I talked about earlier, like, how do I tell when a company's not doing well? Are they putting money aside? Are they repairing the roof when the sun's shining? That is what the US government is not doing. You know, the last 2 or 3 years in the US economy have been great, and the deficit is still massive. That problem will come home to roost if you have some kind of slowdown or recession. If you start a recession and the government spending increases dramatically from wherever it was, so if it increases dramatically from 7, it gets to 10 or 12 deficit very easily if you had a major recession in the US in the next couple of years. That would be just diabolical. That's numbers that start to look like Greece and Portugal during 2012. So that's what a bond market analyst gives you, is to tell you where is the medium-term risk. And right at the moment, the medium-term risk is the US government credit profile.
What makes a good bond analyst? You're hiring someone into your team. What makes a really good one? What stands out to you?
Curiosity and just a dose of arrogance. Curiosity, because you need to understand, like, you've got to be good at maths as well. You're good at numbers. You've got to be curious. Like, why is this happening? How is this happening? Why? What's going on? Explain to me what's going on. That's really important. Oh, everyone says it's because of this reason. Nah, they're wrong. Yeah, that's where the dose of arrogance comes in. So you've got
to be able to back yourself.
Yeah. There's no point just sort of being curious and saying, well, everyone else thinks this, so that's what I'm going to think. That won't get you there. You just have that. You need to be able to stand on your own 2 feet. So, like, everyone else is saying this, but I can see this other risk too.
And the data here, I've gone out, done the work. Here's the data to prove I'm right.
Yeah, that's what makes a good bond analyst. Curiosity. Just got to be curious about the whole thing, and once you understand it, enough self-confidence to think, look, I understand it better than other people.
I'm curious as well, when you're playing in a space like the bond market and you are playing against very large institutional investors, literally companies that have like $1 trillion under management, how is it competitive to get exposure, to get access to the bonds that you want to get access to? I'd imagine that the biggest player in the room gets to eat first.
Often not. Actually, a lot of large companies like to deal with FIIG because the trouble with very large, huge companies, PIMCO's not a great example because they are a little bit different, but like huge hedge funds who will buy all your bonds today will sell them all tomorrow if they want to. And that's not what you actually want. If you want to have access, if you're a company, you're issuing bonds, you want to have a nice, stable bond market where your price is nice and predictable. You don't want to have someone who loves you today and hates you tomorrow. That means your price will swing dramatically. So actually a company like FIIG, which is, yes, smaller, but has a longer term time horizon, a lot of those hedge fund type investors, the largest investors in the room, are
highly active.
They're buying for a week or days even. And that's not actually what investors want. That's not what borrowers want. They want to borrow money from people who are going to be with them for a longer term.
Stability.
Yeah. So we actually find that we tend to get more respect. And in fact, some companies even seek us out because they can get that access to that medium-term investment from investors who are trying to invest for the medium term and you don't want to. So yes, you might be able to borrow money at 5 basis points lower or something like that if you took the money from a hedge fund, but then you might regret that the next day. Whereas if you're trying to build a business with a more medium-term focus, you want a medium-term investor, and you don't get that from the largest guys in the room. You get that from people like smaller players like FIIG, superannuation funds, actually. We have more trouble with superannuation funds because they are also medium-term investors and can be very large.
I want to ask one question here and then get into a couple of personal reflections that we always wrap up with. But can I get your take on, I think at the moment there are some people out there who are getting that fixed income basket or that fixed interest basket of their asset allocation potentially confused with private credit. So can we get a definition between, so people can come at it with open eyes, what's the difference between a bond that you've researched and the private credit offerings? Because we have seen over the last few years a lot of cash move into that private credit space. We've seen a lot of, some very high numbers in equity-like returns in that space. And I'm guessing that some of that capital that would have otherwise gone to bonds may have gone into that space and be fitting in that asset allocation of fixed income.
Yes. The reason private credit gets equity-like returns is mostly because it takes equity-like risks. It's a fundamental principle of investing. You get recompensed for the amount of risk you're taking. Private credit is a type of loan. Bonds are a type of loan too. So the distinction between a bond, private credit, and equities. In equity, you actually own part of the company. We're not talking about that side. We're talking about the lending money to a company side. Now, if you buy a bond with FIIG, that bond is openly traded in a market. That's what distinguishes it from a loan. A loan sort of exists and it sits there and it's sort of one-to-one and you can't trade it each day. A bond, I can tell you the price every single day for this bond for the next 10 years till it matures. Whereas a private credit, there's no traded price, there's no clear transparency, which means that during strong periods, private credit does really well because there's no problems. You get your money back every time. As soon as you start getting into a problem, you start asking questions of what that loan you made to that small company, what's it actually worth? We think it's still worth 100 cents on the dollar.
There's a lot of conversations at the moment. If you open up the Fin Review, you would see reports of ASIC asking those questions. How are people valuing those assets? And in private credit funds, they are valuing them because they say that's what they think it's worth. So they're valuing their own assets. In FIIG, we have an external provider that looks at the bond markets where it is trading each day, and they value the market. They value the bond holdings externally from FIIG. FIIG has no say over what those prices are. They get valued externally. And that's the big difference. So that's like a functional difference. Now, conceptually, you could do a private equity, like a private credit loan on a sort of very low-risk company. They tend not to be that, though. They tend to be quite high-risk loans to high-risk companies because they're ones that don't necessarily want the transparency that comes with either opening up your books to a bank or opening up your books to the bond market. So you have those. If you're trying, remember I said right at the start of this conversation that if what you're trying to achieve from your bond portfolio is the absolute highest return, you'll end up in quite risky companies that don't do what you need them to do when the problems start. That, to be honest, private credit is that on steroids. You're taking the very highest risk loan that had the very highest returns, that if you do hit a problem, that's when you won't get the bond-like returns that you actually bought bonds for. If you bought bonds so that on the day that the equity market has a problem, my bond portfolio does really well, so my overall position is diversified. If your position is in private credit, you don't really have that diversification, because you've got a whole lot of credit risk sitting inside that private credit
investment. It's got equity-like returns because it's got equity-like risk. And that's the fundamental point.
You would put it in an equity category?
Pretty close, yeah.
Pretty close. Okay. It's on that border.
Oh, very much so, very much so. But bonds are a gigantic category. Bonds goes everywhere from like a 1 month loan to the government, to the federal government. That's called a T-note. That's the highest probability of getting your money back. It's functionally 100%. It's the single lowest risk investment out there. Then they go through government bonds with a bit more interest rate risk. State government bonds got some credit risk. Companies got a bit more credit risk. Then you go through down to. Remember we were talking about the ratings earlier. A lot of these private credit they are double B, single B, triple C type loans. Now they have every right to exist, but they are not going to behave the same.
They shouldn't be mistaken.
They are
for
not
a bond, or they are not a substitute for it.
Yeah. It's sort of like saying, I've got an equity investment. Oh, what did you do? Oh, I bought an IPO from a small mining company. Oh, I bought a Telstra share. They're the same. No, they're not. That's what the bond market, and because people don't know the bond market as well, they don't understand the fundamental distinction there that kind of private credit is a loan, but it's the very riskiest end. And it's not going to behave the same way in a problem, like during a difficult period, as a much safer investment in what would be like an old school bond.
I just want to now, let's, in the closing kind of moments, I'm curious, for those who are curious out there as well, starting to get interested in bonds and hearing more, finding out more about them, are there any books or what resources that you'd recommend? To read up on the history and the intricacies and
the intricacies. No, unfortunately, bond markets are just not like that. I will say that one of the most fascinating books I ever read was a book called Debt: The First 5,000 Years, which traced the history of how humans have traded money and traded debt for 5,000 years. It goes right back to the barter system and how that relates to modern debt trading. It's really quite fascinating, and you will get a much better view of how debt markets work. And the other one is, it's not quite about debt markets, but it is very much the way humans and markets work, is a book that you probably will have heard of called Thinking Fast and Slow by Kahneman.
I've got a copy on my bookshelf, and I must admit I've not read it.
Oh, you should, mate. You should.
It's been sitting there for years.
It is one of the most fascinating things. Humans love to think that they're rational and intelligent, and it's not. It's how our brains use shortcuts to trick ourselves. If you've got a second, I can tell you one of the most famous stories in the book.
Go.
Was about a childcare centre that came to an economist and said, we have this problem that people pick their kids up from childcare late. So what we want to try and do is to try and come up with some system that means they'll pick their kids up
on time.
And at the moment, we have data which says that at the moment, on any given day, 10% of kids are picked up late. Okay, let's put a small penalty. So if you pick your child up after 6 p.m., you have to pay an extra. Now, it was actually, the study was done in Israel, so it was shekels, but concept doesn't matter. You have to pay an extra $25 if you pick a child up between 6 and 6:30, and an extra $50 if it's between 6:30 and 7. And there we go. So now that if you don't pick up your child in time, you have to pay extra money. That should mean that there are more children get picked up on time. The exact opposite happened. In fact,
they put a price on it, saying,
fewer children got picked up on time because now it was $100 for a day, $125 for a long day, and $150 for a really long day. Take your pick. And people were saying, well, actually, today I got this really important meeting. I'll take the $150 option, please. And it's about how the intuition of, of course, you put a price on it, people will do it. You give them a penalty. Like, no. Oh, you've told me what the price is. I want to buy that. I'll have that for that price. And the whole book is full of stuff like that. We're just talking about how humans think and how humans think irrationally and how that interacts with the world.
That's great. Just finally, last question. We ask this of all of our guests. If you could go back in time and tell younger Philip one lesson about the world, investing, finance, take it any way you like, what would it be?
probably going to be a strange answer. I'm going to tell you that the Australian system, the Australian government, the Australian markets are incredibly well run. Do not believe that the rest of the world is as well run as we are. And so when I've made big mistakes in my career, it's because I've looked at it and I thought, there were some issues there, but nothing so serious that the American regulators won't be able to handle it.
Or you made the assumption that the rest of the world
was as well run as Australia, and it wasn't. So I wrote a piece about subprime mortgages a few months before the financial crisis. And I must admit, like at the time, I got some blowback for saying, look, actually, like these are quite risky. But in Australia, they're a little bit risky, but they're not silly. And I left it there. And I should have done, yeah, but what about in the US? Are they silly in the US? And the answer was, yes, they were. Like in Australia at the time, the most you could borrow against a house from anybody was from RAMS. It was 103% of the value of your house. Like at the US, you were doing like 115 and things like that. And it's like, actually, that's a really big difference. So like if you buy a house and get lent 115% of the value and then it falls 10%, suddenly you're 25% in the hole really quickly. And I just didn't think that could happen in America because it couldn't happen here. And that was the big difference. That sort of appreciate how good Australia is to live in and how well run it is, because it's actually blinding you to how mistakes will happen in other countries. That's
fantastic. Out of every single Australian Investors podcast I've listened to, and I've heard that question asked probably well over 100 times, that we've not had that answer. So thank you.
Well, good.
Philip, this has been a wonderful conversation. I really enjoyed having you in the office here, and I'm looking forward to doing it again.
Oh, thank you. Sounds good.
Cheers.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.